So I'm going to start with one of yours that you came out with, because I know that you were traveling here, so you didn't get a whole lot of time to do some preparation for this. So I'm going to give you some of the ones that you said here. But the first thing that you said for your bold prediction for 2021 was that at the time where we reported, we were doing the episode, which was sometime in January, I think, right?
It would have been, really early in January.
Sure. You said that you felt the market was overheated and that you would not be surprised if we would see a correction in the near future. And I always expect a correction every year at some point in time. But you were pretty darn close, because that couple of months later in March, we did face a correction where we had some sell-off. And the sell-off was so quick that some of our investors were calling saying, hey, should I be buying gold? Should I be moving to a defensive position? And no, in that instance, we just stay the course and we maintain our strategy. We don't make a rapid adjustment just for the correction.
Yeah, I mean, like we just said, like a correction is just pretty much a buying opportunity depending on the circumstances, unless it's like a fundamental shift, like something that happened in like 2008 or something like that.
Yep. Yeah. So Derek, you're 1 for 1.
Nice. Okay.
So my first thing that I don't want to say that I'm right on because I don't think the reasons for where they're at was because of my prediction, but I said that you should avoid investing in battleground stocks. We were just coming off a nasty presidential election, and we had the president of the United States that was banned from Twitter, and he was a lot of the apps out there. Amazon Web Services took the Parler app off their server, I guess, if that's the word to use. Apple got rid of their app as well. And so I was mainly focused on Twitter. And I said, you don't necessarily want to invest in a battleground stock, because there were a large percentage of people who were at that point in time. And remember, Americans have short attention spans. They were closing their Twitter accounts. The interesting thing, though, is that Twitter does not, they're global, right? So just because there are accounts that are being closed in the United States doesn't mean that Twitter's not growing as a stock. But Twitter has trailed the S&P 500 as far as its return. Twitter's probably not a stock that I would be a long-term investor in anyways.
Yeah.
That's just my feeling on it. But interesting enough, Apple and Amazon are both down for the year. If you would told me that would be the case in 2021, where the economy was opening up and continuing to grow, I would have thought that would be an odd situation. But the reason that those two are down, I don't believe have anything to do with being a battleground stocks. I think they're down because of their multiples.
Sure. I agree. Yeah, totally.
So we've seen that with a lot of companies that were high flying through 2020. Basically, anything that was a COVID stock or benefited from COVID has not got permission by the market to move forward a whole lot in 2021.
Yeah, and I think that it could be a different situation ending the year. I think that those could end up having solid years.
So here's your Oracle of Orville take that you had here from your bold prediction for 2021. You did some research and you went all the way back to 2008, and you looked at the sectors that had 2 consecutive years of underperforming. And you had said that the financial industry had done it in 2008 and 2009, and then you said the energy sector had done it. But the energy sector had underperformed for the 2 previous years. And you said that it was highly unlikely, in your opinion, that the energy sector would continue to underperform in 2021. And not only were you right, but the energy sector has been the best performing sector through 2021. So nice job, Dirk.
Thanks. And then I didn't back it up with any muscle, though, because I actually didn't buy the energy sector. So who cares if I'm right? If I just said it, I wish I would have bought, Yeah.
Well, we were so convinced, at least in the conviction, that we've added it to our investment models.
Sure. Yeah, we did do
for
that.
Clients.
Yeah.
My second bold prediction was that we would no longer need to be purely in growth in order to make a buck. For the past 10 years, if you look at the comparison of the NASDAQ versus the S&P 500, the NASDAQ is largely, at least the NASDAQ 100 is largely growth companies, heavily favored into tech. The NASDAQ has crushed it over that period of time. But now we are seeing a little bit of a shift here, and value has come back to favor. And so I was correct in that.
Yeah,
I said
you
that
knocked that one out of the park for sure.
Well, I said that didn't mean you want to sell your growth stocks. It just means that you no longer have to be in growth to make a buck, and it's actually been a much easier path if you've been in value in 2021.
But also, I think you're right on the second half of that as well, where you didn't want to sell your growth stocks because some of our tactical model names have performed well in 2020 or 2021 as well. So
Yeah, and they seem to be gaining some footage, and I'll kind of get into that here because I'm going to get into the one where I was pretty wrong on so far. As these companies report earnings, and they're still having these solid earnings, even though they've got these high multiples,
really good, really good quarters.
it's only a matter of time before the market can ignore that.
I agree. Like you can only take so much. Zoom has its own issues, and I don't own Zoom, but I mean, when you have 191% year over year, was it revenue growth?
Revenue growth.
It's like I'm not saying it justifies like a 200 times earnings multiple or anything, but it's like after falling down 30% or whatever it did in March, it's like you have to give the devil his due, I guess, or whatever metaphor you want to use or whatever. But you can't treat that lightly if they have that much growth, and that's going into a scenario where we're getting out of COVID. I think that's pretty impressive. And then Apple's the same way. Amazon, like just pick your name.
Yeah, solid earnings. And I had actually on the last podcast, I had said I was a little bit wary of Zoom because they were going to have comparables that were no longer, gimmies. They were comparing themselves to 2020 when they were roaring, right, and doing very well when everybody was using Zoom, but they still managed to grow substantially, significantly.
And the shares were actually flat, post earnings, yeah. And then you said DocuSign as well, which traded higher, that was a good call. That wasn't your 2021 prediction, but you made that prediction a couple weeks ago, or was that last week?
Did you see how much higher it jumped?
It was like 16% or something.
Yeah, it's crazy.
It's a big jump.
But DocuSign if anybody's ever used it, it's a fantastic product.
Yeah, but it's strange because that one has a pretty high multiple as well. You wouldn't have expected that. Post earnings.
Yeah.
So you would have expected that long term, but not post earnings,
Right. Yeah, because basically the market has basically yawned at everything that everybody's put forward, unless you're a value company, unless you've got a little bit of a lower PE.
Yeah, or NVIDIA. NVIDIA had a great quarter, and it sent them higher. But NVIDIA and Salesforce, I would say, because for the past couple quarters, the market hasn't respected their quarters, even though they've been blowout quarters. And then, like you said, it's like it comes to the point where it's like, okay, it's like it shouldn't be trading lower than it was 3 months ago or 3 quarters ago when the numbers just keep getting better and better and better. So you eventually have to start buying.
Yeah, I agree. When I said that you no longer have to be in growth, one of the things I said was I was looking at industrials. And part of the reason for that was a potential infrastructure spending bill coming due. So the two companies that I was looking at was Deere and Caterpillar. So far, year to date, Deere is up 32%, and Caterpillar has edged Deere out by about 2 percentage points, up 34% for the year.
Yeah, that's a good one. That's a good one.
This was your best one, though. This is the one I think even better than the energy sector.
I think so too. Because think about the environment that we were in. This was we weren't. This is because we had a pretty nasty correction in March, and then even in May, a lot of those high flying names, they really got slaughtered. So now it looks obvious, but I just want to preface this where we were, everybody was bullish, and then so go ahead. What did I call?
You came out and you angered Elon Musk, and you said that Tesla was going to underperform the S&P 500 in 2021.
That's why he's been so mean to my Bitcoin position. Because he listens to that podcast.
Yeah. Well, so yeah, Tesla has taken it in the rear mostly of all of 2021. And despite that, its PE is still, I just checked it before I got on here, its PE is still 600.
Oh, jeez. Yeah.
So in an environment where the market is punishing companies with high multiples, 600 is beyond high.
Yeah. And I think it deserves a premium. I think Tesla deserves a premium, especially if, because it's not just cars, it's the brain of Elon Musk, basically, and all the stuff he's doing with Boring Company and solar panels and all. It's all that stuff. So it deserves a high multiple, but yeah, 600 is still pretty stretched, even though I did buy it on the 30% correction. I have been purchasing Tesla to my downfall, I guess, because it keeps going down, but it's all good. Long term, I think that Tesla's a good one to own.